Okay, good afternoon to everyone. Can you all hear me and can you all see the screen? If you can, just send me a message saying yes, please.
Yes.
1%. Can, right?
Yeah, all are okay.
All right,
Yes.
thank you. Okay, now the past discussion we had on the overall view on financial system, and then last two discussions we had on interest rate analysis, right? So today we are going to have a discussion on exchange rate analysis, right? So basically about what is exchange rate and how to calculate those, and what are the determinants of exchange rates, and in an exchange rate market, how the rates are determined in short run and long run. That is our analysis, right? So we start with the first kind of introduction for exchange rates, right? Now, the exchange rates are determined in a financial market that's called foreign exchange market, where like the buyers and sellers quote their price. Ultimately it's the equilibrium, so called exchange, right? So what do you mean by exchange rate? So like about exchange rate, you might have seen in the market, be dollar or euro or like yen. So different exchange rates are there, right? So when you see what is exchange rate, there is amount of one currency needed to purchase one unit of another currency, right? So currency in terms of, that's the exchange. Now if you are going to buy dollar, right, so you have to pay for that. So you are going to pay by LKR, Sri Lankan rupees. So if you're going to buy $1, what's the price of that dollar in terms of Sri Lankan currency? That's the exchange rate. So you are getting currencies at a determined rate. So that is called exchange rate, right? See the screen, right? Okay. Right. Now you can see. Now, how do you code this exchange? Now you know what is exchange rate. That is determined in a foreign exchange market. Fine. Now, you can see how these exchange rates, sorry, you should be like very careful when you write those codes, because if you don't write the codes, that may mislead the reader understanding the codes. Now, first I have mentioned, like you can see, E, that means exchange rate. First, sterling pound. So sterling pound sign and divide by dollar sign is equal 0.63. Right? This is the exchange rate of euro dollar exchange rate. We call it euro dollar exchange rate. Right? It means, now you can see the numerator is sterling pound, right? Numerator is sterling pound. Yeah, sterling dollar. First one is sterling dollar. Numerator is sterling pound and denominator is dollar, right? First one. So it says, what is the price of a dollar, right? So denominator is dollar. So that means what is the price of a dollar in terms of sterling pound, right? So means $1 is worth for how much? How much is worth for $1? So $1 is equal to 0.63 sterling pound, right? So you have to see which currency is mentioned as denominator, right? So that is always one, right? $1. And numerator, so it's a sterling pound or whatever the currency is, you are going to say, okay, that is equal to 6.63, right? So that is the way. So don't confuse, like normally, like if you are not in the practice or not in the market, foreign exchange market, then if you don't have any experience, so sometimes you get confused, right? So to avoid that, just think, right, the way I explained. And also, if you have some kind of exchange rate ideas, you can decide, you can reconfirm that using the exchange rate, right? So value of sterling pound is more than value of a dollar, that we know. So then if you give $1, definitely you are going to get below 1 sterling pound, right? So that also you can recheck and see if you know the exchange rate pattern, right? Current exchange rate, right? That also possible. That is to use reconfirm your idea, right? Because this is, you can always rely on that because it's always changing, right? You can see the second example, exchange rate, right? Dollar sign divided by euro sign, right? That means, right, it says 1 euro is equal to 1.35 USD, US dollar, right? So this is the exchange rate way of quoting and way of understanding, right? Okay. So now you know what is exchange rate and how to write and how to quote. Okay. So these exchange rates are quoted in different terms, right? Based on the time factor. The first one is spot rate of exchange. That means if you want to buy immediately or maybe on the spot, then the exchange rate would be called as spot rate. That means you go to a bank, you are going to buy USD, then you can ask over the counter. OTC means over the counter. You can ask the counter, okay, I want $1,000 or $1,000, right? You want $1,000 to buy. So they will say immediately, okay, this is the rate now you can buy. That is called spot rate. The price of a currency for immediate delivery. That means you are going to give LKR and over the counter you will get dollar immediately. So that's happened on a spot time. So that is called spot rate, right? Let's assume like you want to buy a dollar. Now example, you are going to import a car It's coming from Japan, but it will take for month or for a month, right? So you have to pay to the supplier end of Jan. So you don't need the currency immediately, but you need the foreign currency end of month. So now you can do two things. You can buy today itself and keep it, or you can buy end of the month. If you buy today, the advantage is you know the current rate, right? You can buy and keep it. But only thing is, if you buy and keep it, of course, you are not going to get any return out of that, one thing. Or like sometimes when the exchange rate changes, the end of the month may be like lesser rate you can buy, right? That's one point. Or you can wait until end of the month and buy during that time on spot, but only problem is you don't know the rate. It can be like gone up, right? So you will be losing. That means like today maybe to buy $1 you have to pay 180 rupees, but end of the month you maybe need to pay 200 rupees. So then if you buy today 180, at 1 month later 200, then you are going to lose 20 rupees per dollar. Now you have to take a decision. So you can go to bank and say, okay, I need a foreign currency end of the month, but I need the fixed rate today itself. So bank will say, okay, we will go for forward exchange rate. Under that agreement, we agreed for a price today, exchange rate today, but we will deliver the currency end of the month. So you confirm the price today, you are deliver the currency at the future date. So forward exchange rate means the price of a currency for a delivery at some time in the future. Like today you use to determine the price exchange rate, but delivery will take place in the future, right? So always, even though we say like spot rate, there can be forward exchange transaction, and you can for a forward exchange rate. Clear? Okay. And in the currency, sometimes the currency appreciate or depreciate. Now let's assume like, right, as I said earlier, what is mean by foreign, it's a price of one currency in terms of another currency, right? So normal goods and services, if you want to buy a good, right, it can, right, maybe the price can change, go up in the future or go down in the future for a normal goods and services. Similarly, this foreign exchange, that's the price of a currency in terms of other currency, can go up, can go down, right? So then that will affect the value of the currency. So in a good market, you can say the price changes or inflation, maybe deflation. If prices are going up, inflation. If prices are coming down, deflation. Right? In a foreign exchange market, right, it can be appreciation, it can be depreciation. A currency rises in a value related to another currency, that is appreciations. You are going to compare LKR and USD, and if the LKR value related to USD appreciated, here you have to carefully look at this. I'm talking about value, not the rate, right? So if the value of local currency or like rise USD, that means LKR appreciated. So depreciation means a currency falls in value related to another currency. So there should be always a comparative figure, right? It's a currency. So if LKR's value falls compared to USD, that means that is depreciation, right? So in an example, we can see when a country's currency appreciates. Now Sri Lankan currency appreciate. That means value appreciates. The value appreciates means you can buy more goods than previously happened, right? So value is always measured in the purchasing power, right? Right. So when a country's currency appreciate, the country's goods become expensive because like now our country's currency appreciates, right? So if they want to buy a Sri Lankan product, now they have to pay more. Who? Foreigners, they have to pay more because the Sri Lankan currency appreciates. And foreign goods in that country become less expensive to domestic economic agent. That means as well as like if we are buying a foreign good, that means imported good, now our currency appreciated, so then that would become less expensive to us, right? So you can see now, right? So when the currency appreciates, right, the foreigners may face difficulties or in the sense high expense to buy our local products. So same time, the foreign goods may be cheaper for the local agents, local people, right? So this is the outcome of appreciation. Or if it is depreciation, it's other way around. Clear? Right. Now, I just want to like extend it. When you say like again currency appreciate, that means the value rises, means earlier I bought USD for 200, but I can buy now 150 rupees. So then my currency's value, right? Currency value appreciated, right? So now if there's a goods in the market, right? It was sold at 200 rupees. So the US people were able to buy with $1. But now $1 is equal to 150. So to buy a 200 rupees worth of goods, they have to pay now, right? Maybe $1.30, right? They have to pay more than $1. So now local goods are very expensive for them. Similarly, earlier I paid 200 rupees in Sri Lanka to buy a $1 worth of goods, but now I can pay 150 to buy that same goods. So for local people, now it's less expensive because of the appreciation. Clear? If you have any doubt, you can send me a message. I think all okay. Okay. Now we have seen the exchange rate and appreciation, depreciation. Now we have to see what is cross exchange rate. So second is cross exchange rate. You should be able to know how to calculate cross exchange rate as well. What do you mean by cross exchange rate? The exchange rate between currencies calculated by the relationship to a third currency. Now, actually, what is happening in the market, right? So, what's happening in the market is now, okay, some currencies exchange rates are readily available. You can go to like Bloomberg and get the rates, right? USD Euro, USD Sterling Pound, or USD, whatever the rates, it's available. But if you are going to buy from a bank, right? If you are going to buy from a bank, they will have some kind of calculation because some exchange rates are not readily available, or sometimes bank also may be practicing in little bit different calculations or with the margin, the same calculation with the margin. So they also will calculate against it, right? So let's assume you don't have the rate, you have the rate of euro dollar, you have a rate of sterling pound dollar, but you don't have the rate of euros, right? Now the questions come. Now if you got like, okay, even Sri Lankan rupees, that won't be available. The exchange rate for like Sri Lankan rupees versus Zimbabwe, right? Or Mexican, right? So you may not be having exchange rate readily available. So how to calculate? So how to calculate means, now you know, now let's assume Mexican peso we don't have, right? So then I have the dollar peso exchange rate and I have dollar rupee exchange rate. You take two both together and calculate peso rupee exchange rate. That's a cross exchange rate, right? In example, I have given U dollar exchange rate and sterling pound dollar exchange rate. Now we have to calculate sterling pound euro exchange rate, right? What is the exchange rate for British pound and euro? So exchange rate for British pound euro, right? That means how much is euro for a one British pound, right? That is the question. Now you can see the formula, right? Exchange rate within bracket. These are very important because if we write only, we don't get confused. Exchange rate within bracket, euro divided by sterling pound. That means you are going to calculate how much is the euro worth for one sterling pound, right? Because the denominator is sterling pound. The formula, right, is you can see, right? You have to now put together this formula, right? There the people get confused. So which rate is denominator? Which rate is numerator, right? So that confusion is always there, right? But you have to keep in mind, in this formula, finally you are going to have the sterling pound is denominator and euro is numerator. So you have to put these together, this formula, and see, right, whether that's happening. Now let's see this, the final one, right? I have highlighted here. Now if I put this formula together, the exchange rate, right, sterling pound to USD multiplied by exchange rate USD Australian pound or euro, right? So you can see now, if you like simplify this formula, now the final version will be, right, because this $2 sign will disappear, the final equation will be euro over sterling pound, right? So this is kind of mathematical computation, all right? So you also, with the rationale, you also understand this rate can be obtained by dividing sterling dollar exchange rate by euro dollar exchange rate, right? So just work out and see. When you work out, you will find this very easy, right? So answer is 1.58365 divided by 1.35973. So the answer is 1.16468. So that means 1 sterling pound is equal to now 1.16468 euro. As I said earlier, you also can calculate or reconfirm this one using what? The current exchange rate in the market. So normally the euro values are, right? Yeah, euro values are, if you compare sterling pound is higher and euro is less, right? If you give a 1 sterling pound, so then you have to give more than 1, right? So then that is 1.16468. So the answer is correct. But if you divide the other way around, this will be below 1. Then you can reconfirm something wrong in the calculation, right? As for that is for kind of reconfirmation. But you have to do the calculation based on this formula. Clear? Okay. So then, like even you just try and see. Now I have given, right, very first exchange rate, that is euro to dollar exchange rate 1.35973, right? That is euro dollar exchange rate. What is the value for dollar euro? That means $1, how much a $1 is worth for euro, right? So can you like try this one? The first one I highlighted here, and see now this is €1 is equal to 1.35973 dollar. My question is, how much euro is worth for $1, right? Okay, so those also, now if you are clear on that, so then you are okay with this exchange rate calculation. Okay, The answer would be, if you take 1 over 1.35973, you'll get the euro currency value for a $1, right? Exchange rate, right? Exchange rate. Okay, fine. Okay, now up to now we were talking about the like basics of exchange rate and how that would be calculated, right? Now, how do we arrive this exchange rate? I said like a foreign exchange market, in a foreign exchange market, the rate would be determined. Now, what's the rationale behind these rates? What is the rationale behind these rates? So there's a theory called the relationship of this exchange rate, right? There's a theory called law of one price. Very important theory in a foreign exchange analysis, right? Law of one price. It means the price of goods in all countries should be equal when translated into a common currency. This is what it says. Now, everywhere Sri Lanka, if you take, sorry, everywhere in Sri Lanka, we are using LKR, rupees, right? If you take the price of goods, everywhere should be same, right? So that is law of one price. If you assess or if you value a good in a currency, that value should be same for wherever it's sold. That is law of one price, right? Good should have a single price wherever it's sold. Okay, right. So now, so any price, you can take any price, right? This law of one price with some kind of assumption we'll discuss later. But basically, right, should be one price wherever it's sold, right? Okay, now you can take any product anywhere in the world and convert it into a common currency and see whether that is equal. But law of one price says that should be equal with some assumption, right? Now, if you are going to buy 1 kilo of rice, and if you are going to buy 1 kilo of rice in US, if you convert those prices into a common currency, it can be LKR or it can be USD or it can be some other currencies, but common currency, the price should be same. That is law of one price. Okay, let's see an example. Dollar price of goods in USA, right? Dollar price of goods in USA, right? So USA, you are going to buy a good, that's price is $900, right? Okay, so that should be equal to the peso price of goods in Mexico divided by number of pesos per dollar, right? That means, now if you take the dollar price of a good in USA, and if you can multiply that with the peso USD exchange rate, okay, or USD peso exchange rate, that price is equal to dollar price, right? That means if you are going to convert, you take, okay, one good is sold at $900 in US. Same good is sold in Mexico. If you convert that price, because Mexican good, okay, good in Mexico would be sold in peso, that's the Mexican currency. If you convert that price into USD, that should be 900, equal to $900. That is law of one price we have seen, right? Okay, I repeat again. You take a good in US, you know the price in USA in USD, and same good you find in Mexico, and then you convert that the price of the good to USD. If you compare both prices in USD, that should be same, right? How do we get that? So now, like we assume like that particular good is $900 in USA, right? So if you want to like find out the price of the good, okay, in Mexico, so you can just multiply the USD price with the exchange rate, you will get the price in peso, right? Okay, this is we are talking about gold price. So gold is sold at 900 USD in US, right? The exchange rate for a USD peso is 10.9143. So if you multiply with this exchange rate with this USA price, you will get 9823 pesos. So I assume the price of gold in Mexico should be 9,823 pesos. But there can be differences. The actual price in Mexico for a gold may be different. That's a different story. So the law of one price says if it is $900 in USA, so at the exchange rate of 10.9143, so definitely in Mexico, that gold should be sold at 9,823 pesos. This is the theory. But in practice, Mexico, the gold price in Mexico may be more than 9,823 pesos or less than 9,823 pesos. That nobody knows, right? In the sense, current price. But law of one price says this should be the price if the law of one price prevailed. Clear? Okay. So other way around, even you can see the exchange rate based on this law of one price, right? So you take the same good, right, in various like two places and compare and see the exchange rate between this good. So that is the exchange rate, right? So law of one price. Any question? Okay, why we are saying like that? That's the question now. Why I said like it should be like the price should be one wherever it's sold. Why is that? Right? Now you can see even, right? Even like Colombo, Nuelia, right? The same good, but maybe different prices, right? Because of, right? Maybe transportation cost, maybe some other barriers. So the assumptions, like I will explain later. Okay, all same. If you take all same, in the sense, other factors are held constant, right? So then the goods in Colombo and goods in New Orleans should be same. Why? Suppose, like I tell you this example, suppose the price of pizza at one restaurant is $20, while the price of same pizza, right? Pizza is same, no differences. At an identical restaurant, the same restaurant across the street is $40. What do you do? Now you find two shops nearby. One shop says pizza is $20 and others restaurant says pizza is $40. Now what will happen? Now same pizza, restaurant is identical. So where do you go? Everything is same. Emotion same, okay. The environment is same, pizza is same, taste is same, everything is same. So definitely we'll go a rational consumer. Definitely he goes to the restaurant where the pizza is sold at $20. Right? What will happen? What do you predict? Many people would buy $20 pizza and few would buy the 40 ones. Right? You can think of, right? Okay. Now, due to the price differences, now entrepreneurs would have an incentive to buy pizza at cheap location and sell it at the expensive location for an easy profit. So what they can do now, you can buy $20 pizza and you can sell it at for $40 now, because like, two different places. So if that happens now, because of this $20 pizza, like there will be a strong demand, right? So this $20 pizza will increase, right? Its price. So $20 will increase. On the other hand, like $40 pizza, he can't sell anymore, right? He will reduce the price, right? So then price, one side, that low price will go up and high price will come down. So people, they will have the incentive to adjust their behavior, and prices would tend to adjust until one price is achieved across the market, right? Across the restaurant. So if you go anywhere in the restaurant, the price would be same. If the product and the restaurant, the products are same and restaurants are identical, so then the price should be same. Otherwise, the market won't reach to the equilibrium. So definitely the market mechanism would work. So that's what it says. Law of one price will provide. Okay. Okay. Now, as we discussed, like consider pizza restaurant and Seattle, one across the border in Vancouver, right? So Vancouver in Canada and Seattle, you can see across the border. The law of one price says that the price of pizza, same pizza, using a common currency to measure the price in two cities must be the same, right? So now Seattle is in USA, Vancouver is in Canada, right? Very close to the border, USA-Canada border. So according to law of one price, if the pizza is same and restaurant is identical, and if the markets are competitive, and the transportation cost and other barriers are not so important, so then these both pizzas should be sold at one price, right? Look at this formula. Now, price of pizza in US should be equal to price of pizza in Canada when converted to a common currency. How can you convert Canadian dollar into US dollar? That means we have to convert this Canadian dollar using exchange rate, right? So pizza price in US should be equal to Canada dollar USD or Canada USD exchange rate multiplied by pizza price in Canada. Clear? Okay. So now you can plug, right, two variables or figures for two variables here, and you can find out other one based on law of one price. Now, if you have US pizza price and Canada pizza price, you can compute the exchange rate. Or if you have price of US pizza and exchange rate, you can compute the price of Canada, price of pizza in Canada, right? Now, similarly, if you have price of pizza in Canada with the exchange rate, you can calculate the price of pizza in US, right? So based on this law of one price, you can see this. This should be the way happen in the market, where the markets are competitive and the transportation cost and barriers are not important. Clear? Okay. Okay, next important one we are going to discuss is purchasing power parity. What is purchasing power parity? Is the application of the law of one price across the countries for all goods and services for representative groups or basket of goods and services, right? Now we were like talking about one product, that is law of one price. If you expand that law of one price in an aggregate level or in a country level, because exchange rates are not determined for each and every goods, right? This is a country level, right? So if you can apply this law of one price to aggregate level, you would understand, or that is called purchasing power parity. So purchasing power parity is the application of the law of one price across countries for all goods and services, or for a representative groups or baskets of goods and services. Now, you okay, think of a price for a good. Okay, as we discussed, that's a pizza. But now the Sri Lankan, so somebody asked you, what is the price movements in Sri Lanka? What would be your answer? Somebody asks, what is the price movements in Sri Lanka? Just think. If anybody can answer this question, I would be more happy. Fine. Okay. If anybody asks you what is the movement of price in Sri Lanka, are we going to talk about a price of pizza? Or are we going to talk about a price of sugar? Or are we going to talk about the price of car? No, we can't talk about like individual goods, because the question is a general question, right? Question is very general. So if somebody asking a very general question about the price, that means the price level, you are going to say a general answer about the price level. That means in general, what's happening to the prices. Usually, we call it general price level. How do we assess the general price level? Right? Now you might see, okay, what's happening to the Sri Lankan price level or general price level, or increasing or decreasing. Okay. So Sri Lankan price level is measured through an index, right? I'm just giving example, right? There are so many factors and there are few indexes as well, right? So the price level is measured one hand, right? It's a Colombo Consumer Price Index, CCPI. So based on that, when the index increases, you can say, okay, Sri Lankan price level increases, general price level. So if somebody asking price level, you are not going to talk about pizza, you are not going to talk about rice. It's a general price level we are going to talk about, right? So how that is calculated? So that is, you can read from text, okay, for a small explanation. So I can say, like, there are list of goods, we call it baskets of goods. Take the prices, give the weights, and calculate based on that, and see based on that basket of goods. Not, we are not taking all the goods, only selected goods, gives the weights and calculate the consumer price index. So when those selected goods prices are increasing, your general level, the price, general price level increase, or that basket, the price of those baskets of goods decreases, then your general price level will decrease. So now you know, right? Right? Okay, if the general price is continuously increasing, just to add one point, what do you mean by that? The price level continuously increasing means what? That is the inflation, right? Or if the general price is continuously decreasing, that's a deflation, right? Now, the purchasing parity, right, uses this law of one price and define the exchange rate, right, in aggregate level. You can see now, instead of pizza price, we take like level of average prices, general price level, right? So PUS means level of average prices in the US. How do they calculate? As I said, take this few goods, put it in a basket and weight it, weight their prices and get the level of average prices in US. Other hand, P Canada means level of average prices in Canada, and then taking together, you can, right, get the exchange rate, right? So then, in other word, if you take the price level of Canada and multiply by exchange rate, you will get the price level of US. So this is called purchasing power parity. Clear? This is called purchasing power parity. I hope like you understand. Now we discuss law of one price, yes. and then we apply that law of one price, right? And then we talk about purchasing power parity, right? So purchasing power parity means, right, how that exchange rate determined based on, right, the price level of two different countries, right? Or like actually, right, with the exchange rate in one country's price level, you can see the other country's price level, right? So how that purchasing power works. Okay, so purchasing power parity implied that, as I discussed, now you can see Canada, Canadian dollar, USD exchange rate can be determined by dividing US price by Canada price level. The level of average price determines the exchange rate. Okay, let's look at this example in there, that would be more clear. If the price level in the US is $200 per basket, while the price level in Canada is the $400 per basket, that means similar basket, right? Okay, right? So purchasing power parity implies that the exchange rate, USD Canadian dollar exchange rate should be, right, 400 divided by 200. That means 1 USD is equal to 2 Canadian dollar, right? So then the purchasing power parity says, like, if you take two price level, and if you can calculate, right, dividing one with the other, you can go with the exchange rate, right? So purchasing power parity predicts that people in all countries have the same purchasing power with their currencies. That is the law of one price. So 2 Canadian dollars buy the same amount of goods as 1 USD, since price in Canada are twice as high, right? So this is based on the law of one price argument or theory. The purchasing power parity is established. Is that okay? This is a little bit, you need some kind of reading as well if you don't understand. So it's very basic, okay, very simple, but only thing is maybe having few confusion. You can send me message, so then I can answer accordingly. And one more thing I want to discuss, sake of having idea, the purchasing power parity comes in two forms. One is absolute purchasing power parity, other one is relative purchasing power parity. The previously we looked at is absolute purchasing power parity. That means exchange rate equals the level of relative average price across the countries. Now, the relative average price between price of US and price of EU equated by exchange rate. That means exchange rate of EU to USD is equal to price of US divided by price of EU. Right? That's absolute in terms of absolute purchasing power parity. But if it is relative purchasing power parity, we are not talking about the absolute value. We are talking about the related value. That means the changes in exchange rate would be equal to changes in prices between two periods. Clear? Okay, now you know that, like, exchange rate. Now what will happen if the price level changes, right? So relative purchasing power parity is measure the changes in exchange rates, right? That express the changes in exchange rate based on changes in price, right? I explained earlier price. How do we calculate the price level? And when the price increases, that means what? Inflation. So changes in price level, right? We call it what? Inflation, right? Now you can see the formula, right? We are going to see the changes in exchange rate, right? That means the first part is changes in exchange rate. How do you calculate changes in exchange rate? Right? You take two period, right? One is T today, other one is T minus 1, yesterday. Today minus 1, that means yesterday. So today's exchange rate minus yesterday's exchange rate, that's the changes in exchange rate, and divided by yesterday's exchange rate. Then only you can see, right, what is the relative changes from yesterday exchange rate to today's exchange rate. Equal to what? US inflation, right? Today's US inflation minus today's EU's inflation. Means what? The price changes in US minus price changes in EU, right? So this is relative purchasing power parity. Okay, so now you take the changes in the price level between two countries, right? That should be equal to, okay, that should be equal to changes in exchange rate. So now actually why I'm saying this is, in two ways these purchasing power parities are used in economics. So that can be absolute and relative, even when you calculate this GDP, right? So it's always given in purchasing power parity as well, used in with purchasing power parity as well. So you should be knowing, like, GDP in terms of purchasing power parity, if somebody is saying, so it's a relative um, amount, right? Taken into consideration of the price level, right? Okay. Yeah. Okay, next I'm just going to give some example of shortcoming of purchasing power parity, right? uh, One, we can see, like, there's a little empirical support for absolute purchasing power parity, right? So if you can see, okay, as I saw earlier, right, actually these two price level um, are determining this exchange rate. If you check with the in empirical way, means you take the historical data of price level and price level of US and price level of EU, and see whether it equates the exchange rate. uh, like, it's very rare or very little empirical evidence, right? So it differs country to country anyway. Like, based on these literatures, it shows that it's very less evidence. But this relative purchasing power parity, of course, you could see more evidence that's right, that is more consistent with data. But it also performs poorly to predict exchange rate. But even though we say, right, so exchange rate changes can be, right, derived from this, the inflation changes, or like inflations between two countries, but that also poorly predict the exchange rate, right? Now you can see this is a little bit all the data, the yen dollar exchange rate and relative Japan US price level, 80 to 2006, right? The blue line you can see Japan US price level ratio, right? It's coming continuously coming down. But even though the long-term trend is similar, the exchange rate also coming down, but it's sometimes going up, going down. So it's not the clearly predictable, right? So you can see like when the exchange rate is going down, you didn't see a big decline in the price level ratio. Same thing you can see when the price level goes up, you didn't see or like exchange rate goes up, or you didn't see a hike in a price level, right? So like the long-term trend you can see, but still it's very poor predict, right? Okay, that's what it says. And as I discussed earlier, the reasons why purchasing power parity may not be accurate, that means the low of one price may not hold, right? Because always the similar goods have different prices. One is trade barriers. Actually, if you are going to, right, export, there may be so many barriers. Or if you are going to import, there are so many trade barriers. So you can't have a one price. And there are non-tradable products, right? So you will be having, even though you have, like I said, like why this law of one price prevail, because you can buy the goods from the lower price and sell it at a higher price where that is sold in higher price. But some goods non-tradable, or some products and services. Now let's see. Now if you want to do a haircut, right, in Sri Lanka, right, maybe $1,000, right? In Aussie, maybe 50,000 rupees in Sri Lanka, and Aussie maybe $50. That means maybe 7,000 rupee, equal to, yeah, Sri Lankan currency. So can anyone come to Sri Lanka and have the haircut and go? No. So those are non-tradable, right, services, or even similar products, right? So you can't do the transport, right? Non-tradable products. So because of that, you don't find law of one price, right? And imperfect competition, right? I explain, like you can see here, right? The three areas I explained in the following slides. The first I said, like trade barriers and non-tradable products, right? The trade barriers, when it comes to trade barriers, as we discussed, transport cost and government trade restrictions that make trade expensive, and in some cases create non-tradable goods or services, right? Because of that, you can't find the goods and services at one price. And as I said, services are often not tradable, right? Services are generally offered with a limited geographic region. So even within Sri Lanka also we can't do that. So kind of, right? So then services are not tradable. And the greater the transport cost, the greater the range over which the exchange rate can deviate from its purchasing power value. That also, mainly if you are going to import some goods from China or some other countries, so like exchange rate will deviate from PPP based on the transport cost, right? Okay, because that is to capture, right? Okay, this transport cost. And one price, because of that, one price need not to hold in two markets, right? So purchasing power parity, you can implement with those assumptions, right? If you break those assumptions, then definitely it's not going to be same. And second, like imperfect competition may result in the price discrimination, price to market. Now you can see the same product, right? So if there's, like as I said earlier, there should be a perfect competition, then only you cannot sell your product at different prices, because you have perfect substitute and perfect competition in the market. But the market is imperfect. If you don't find the similar pizza or identical restaurant, then you can't find a one price, right? So now even the similar product, right? Even the similar product, right? If there's nobody to supply, then you will price to different price to different market, right? Okay, now and somebody maybe it's the same product, maybe sold at a different price in India and different price in Sri Lanka and different price in US, because the particular manufacturer price that good, that means discrimination price, he discriminate the price to different markets based on the market characteristic. So the same firm can sell the same product for different prices in different markets, so maximize the profit. Now let's see some of the items may be cheaper here, but may be very costly. The same product may be very costly in US or EU, right? Because they target, the consumers, they make the different pricing to get more profit, right? Based on the customers or consumers expectation, right? If same product, if we are not going to buy at the price which is sold at US market, so then they will calculate and say, even though the less price, it's profitable for them if they can produce in mass scale, so they will sell at a less price, right? Okay, now this with this online trading and all, now it's that prices are narrowing down, right, in the current environment. But this was that like perfect case, right, before this famous online trade, right? Okay, and then differences in the measures of average price for goods and services, right? As said, okay, this is how the average price is calculated, right? But the problem is the Sri Lankan basket of goods are different from US baskets of goods, or maybe different from Canadian basket of goods. So our goods are different and their goods are different. So then definitely the average price for goods, the movements in average price of the goods going to be different. That means level of average price differ across the countries because of differences in how representative goods, groups of goods and services are measured, right? If your calculation is different, definitely you're going to have different price level and its movement. Because measures of groups of goods and services are different, the measures of their average price need not to be the same, right? Therefore, one price need not to hold in two markets. Is that clear? So even though there's a law of one price, and then we apply that for this purchasing power parity, that may not be as expected when you relax this assumption and these changes in or measures in differences in price level, right? Okay, is that clear? Okay, up to now we have seen what is exchange rate, right? How that works through law of one price theory and purchasing power parity. And as we saw in interest rate analysis, we saw two different things, right? Two different measurement. So nominal interest rate, real interest rate. Similarly, we also see, right, in exchange rate as well, it's a nominal exchange rate and real exchange rate. Okay. So the real, as I said, always go with the real goods and services, right? So nominal exchange rate, how much you can exchange for one currency to other, right? That's a currency exchange. But when it comes to real exchange rate, that's a rate at which domestic goods can be exchanged for foreign goods. It's a goods exchange, right? Let us look into this example. There's a basket of goods in New York. In New York, you take a basket of goods, it's different goods in a basket that's sold at $50 in New York, 50 USD. The same basket of goods, so same product put in a basket, so same basket of goods is worth 7,500 yen in Tokyo. The one you understand is there's a basket of goods in New York that is $50, and same basket is sold at 7,500 yen in Tokyo. But the third information is the nominal exchange rate is 100. That means $1 is equal to 100 yen, right? So what do you mean by $1 is equal to 100 yen? That means if you give $1, you will get 100 yen. That means that is the nominal exchange rate. So what is the real exchange rate? Right? So when it comes to real exchange rate, we like how many foreign goods you can buy by paying 1 unit of domestic goods. 1 unit of domestic goods if you give to US, and how many foreign goods you can buy. Right? Okay. Now what is the so what is the price of domestic goods? 7,500. But what is the price of foreign good? That is now $50. Your exchange rate is 100. So you have to pay 5,000 yen to get the same good from US. So real exchange rate, right? It's 50 multiplied by 100. That's a foreign good price divided by local goods price. That's 7,500. So now real exchange rate is, right? 1 yen is equal to 0.66 dollar. Clear? Right? Real exchange rate, you can see, right? It's 0.66. Clear? Okay. Now purchasing power parity predicts that real exchange rate is always equal to 1. Right? Okay. So so now you have to understand only one thing. What is nominal exchange rate? What is real exchange rate? Right? Okay. If you can understand the differences between these two, of course, that's fine. Okay, now you can see in the graph the relative price levels, right? That's in red color. CCPA UK divided by CPA UK divided by CPA US and exchange rate, right? That means purchasing power parity compared to exchange rate, right? You can see, right? Huge deviations, right? As I said earlier, right? Okay, so even though the theory says will have a similar, but in practical you can see deviations. Okay, now this kind of applications, just an example to give you, ergonomics, right? Big Macs and purchasing power parity, right? Now we saw that you apply law of one price and see the exchange rate through purchasing power parity, right? So now since 1986 you can see the Economist magazine has published the Big Mac index, right? You know this McDonald's, they saw Big Mac. Yes. So as a light-hearted guide to whether currencies are at their correct level based on the theory of purchasing power parity. Actually, like they wanted to know, we said earlier, law of one, we have discussed what is law of one price, and applying that, how do we arrive this exchange rate based on purchasing power parity. Now this Berg, and we saw also limitations because of the product differences and all these transports and all these things, it won't be same as always. So now this Big Mac is sold everywhere around the world, right? Similar product at different prices, right? So this magazine started to calculate this Big Mac index, we call it, right? To guide whether currencies are at their correct level based on the theory of purchasing power parity. right? As I said, Big Macs are sold by McDonald's all around the world and are supposed to taste the same wherever they are sold, right? The economist collects the price of Big Macs sold in 56 countries or different regions and countries, then uses these prices to compare the exchange rate implied by purchasing power parity and the Big Mac indexed, right? And see, they for the analytical purpose, they take this Big Mac index, right? Calculate and take this, and they take this purchasing power parity and compare it whether this is how far it is close, right? You also can see in detail how that is done. Okay, up to now we have seen, right, exchange rates, how that is calculated, different rates, and then how that is arrived based on law of one price using purchasing power parity. And there are two kinds of exchange rates, kind of nominal and real. And we saw Big Mac index as well. Yeah, in addition to this, shortcomings in purchasing power parity. I hope you understand this one, right? Okay. Next, how these exchange rates are determined in the long run, right? So in economics, as I always say, there can be two different effects for the economic variables. One may be short run effect, other one may be long run effect, right? These two time periods will have two different effects normally, because in short run we assume some of the factors are constant. You can't change that factors in a short run. But in long run, the economists always assume, okay, all the factors can change in long run. So definitely the effect is going to be different. First, what I'm going to see is what will happen to the exchange rate in the long run. Right? So actually in law of one price, we have studied the price of an identical good should be the same throughout the world if trade barriers are low. That's we know. So in long run, this will be the case, right? So the assumption also I mentioned, again, I am just quoting, all goods are identical in both countries. Trade barriers and transportation costs are low, and many goods and services are not traded across the board. With those assumptions, we say like the price of identical goods should be the same throughout the world, right? So what are the factors going to be affect this exchange rate in the long run, right? So we say like law of one price will prevail with the assumptions. If the law of one price prevails, then exchange rate also prevails. But in the long run, right, the basic rule in the long run, anything that increases the demand for domestically produced goods related to trade goods tend to appreciate domestic currency. Right? I repeat it again. Anything that increases the demand for domestically produced goods relative to foreign trade goods tend to appreciate domestic currency. Right? Okay. So the factors that affect exchange rates in long run, one is relative price levels, other one is trade barriers, other one is preferences for domestic versus foreign goods, and productivity. Right? Out of these four factors, any factors, if that can increase the demand for domestically produced goods related to foreign traded goods, right? That means now I have mentioned four factors: relative price levels, trade barriers, and preference for domestic versus foreign goods, and productivity, right? These are the important factors I have mentioned. Due to these factors, if domestically produced goods demanded more, now let's assume based on these factors anyway, within Sri Lanka, we produce goods. If the demand of those goods increases related to foreign traded goods, right? Let's assume like the foreign goods also there, domestically produced goods also there. But now the demand for domestic goods is increases. What will happen? To buy domestic goods, the people need to have domestic currency. Then there will be a high demand for domestic currency. When the domestic currency is demanded heavily, then the domestic currency will appreciate. You can see even normal demand curve, right? Right? So when the demand of a good increases due to various reasons, the price of the good increase. Like that, when the demand of a currency is increases due to various reasons, definitely the currency would appreciate. Okay. In long run, the relative price level, trade barriers, and preference for domestic versus foreign goods, productivity, those would have an impact on the exchange rate. Let's see one by one. The first one, right? The domestic price level. I see a domestic price level. When the domestic price level increases, right? When the domestic price level increases relative to other countries. Now let's you take two countries. Our price level increases more than the other country or foreign country. Then what will happen? Right? That means inflation, right? Our inflation is more than the foreign country inflation. Then definitely the foreign exchange rate will depreciate. You can bring our interest rate discussion also, right? That means when the inflation increases, we are going to have low real interest rate, right? That means that somebody is going to invest on your assets, right? They are not going to get high real return. So they are not going to demand your assets, right? Assets means maybe foreign currency. Then the price of the assets is going to be lower. That means, right, your foreign currency would be depreciates. Your foreign currency would be depreciated. Okay, right. That is one thing. So domestic price level and trade barriers. So if you have more trade barriers compared to foreign country, right? That means your product is going to be available less. Then there may be high demand for that goods, but your supply is very less, so that would be priced up. Then your foreign currency will appreciate. And third one, import demand. Now, when the import demand increases, so that means in Sri Lanka, we are going to import more. To import, I need more foreign currency, right? So I will demand foreign currency more, then their price will go up. That means in terms of exchange rate, our currency will depreciate. Other way around, if the export demand goes up, the foreign country, they wanted to buy our products, export demands go up, then they need our money to buy this stuff. That means Sri Lankan rupee, they need more. So much of demand, so automatically LKR will appreciate. And then productivity. So when the productivity related to other countries increases, we will produce at a lower cost. So our product might be cheaper. Then what will happen? The all foreign country people also wanted to buy our stuff because that's cheaper because of productivity increase. So they need more foreign, like our currency. So then our currency will appreciate. Right? So now you can see in a long run, based on these factors, the exchange rate will be changes. Exchange rate will be changed. Okay. Now, in long run, we have seen what will happen to the exchange rate, right? Due to 5 factors we have discussed, and the relationship between these 5 factors and the exchange rate movement. Okay. Yeah. Next, we will look into the exchange rate movement in the short run. We discussed the long run earlier. Now we are going to discuss in short run. So we'll have a 15 minutes break and start at 3:15. Up to now we have seen the exchange rate in long run, and now we are going to see exchange rate in the short run. That means a supply and demand analysis. I think some music interrupts. If somebody can switch off the music. Gayan, can you hear me? Okay, we will look into this exchange rate in the short run. That means supply and demand analysis. So short run, like you can see, like short run exchange rates are determined uh, based on the supply and demand of foreign currencies. So now in short run, how that behave. So that's what we are going to look into. An exchange rate is the price of domestic assets in terms of foreign assets. So earlier I said like exchange rate is the price of one currency in terms of other currency. Okay, now here it's more clearly, right, says that the price of domestic assets in terms of foreign assets. So here, like domestic, it has been mentioned as dollar, right? I have mentioned as the book stated. So like here you think the domestic currency is dollar, others are foreign currencies, right? So domestic is US, right? You think that way, right? So we are going to see the exchange rate determinants in short run. That means supply of dollar and demand for dollar, right? So domestic currency I say as dollar, right? And other currencies are, right, um, foreign assets, right? Okay, so let's look at supply curve for domestic assets. So supply curve for domestic assets, that means domestic assets, I assume here dollar, right? So we always have the assumption that is fixed. That means supply curve is vertical. I think previously also we discussed domestic and the money supply. So money supply is fixed. So the supply curve is vertical. Right, in an interest rate analysis, we saw that the money supply is fixed, so the curve is vertical. Here also we like take dollar as a domestic assets, so supply curve then is vertical because the curve is fixed. The demand curve for domestic asset, that means demand curve for dollar, right? Most important determinants is the relative expected return of domestic assets, right? Now our domestic assets is dollar. The most important determinant for a demand of dollar is the expected return. So relative expected return, now the investors will look into several currencies. They will see dollar, US dollar, they will see Japan yen, they will see sterling pound, they will see the euro, and they just analyze and see which one gives better return. That is a relative expected return. So if those investors think that the relative expected return of dollar is high, they demand more. Or if they think that relative expected return of US dollar compared to maybe sterling pound or euro or yen is less, then demand will be less. Okay, so then at lower current value of the dollar, that means everything else equal, nothing change, everything is constant, everything else is constant. At lower current value of dollar, the quantity demand of dollar assets is higher, right? Okay, so these two things will have the impact on the demand, right? Let's put it together: supply and demand of the currency, and see how that equilibrium exchange rate is determined, right? Okay, now the equilibrium exchange rate is determined in the foreign exchange market. So we can see the graph. In the graph y-axis, you can see exchange rate. That means ET, exchange rate today. Exchange rate is dollar to euro, right? So how much of euro you can get for a dollar? Okay, as I said earlier, the supply of dollar, that is our domestic assets, right? So y-axis exchange rate, x-axis quantity of dollar assets, right? Dollar assets, right? Dollar, when we say dollar assets, you can think of our treasury bill, US treasury bill, that can be thought of. So, okay, why I'm saying those things is you just keep remember those. You just keep remember those, then you will have some kind of easy understanding, right? Okay, now so when you say quantity of dollar assets, you can think of dollar currency, treasury, US treasury bills, that is dollar denominated US treasury bills, you can think of. And now you can see, now dollar assets, that is fixed, or dollar supply of dollar is fixed. That is S, supply is denoted by S, vertical, right? It's vertical to the x-axis, right? So when that means when the exchange rate changes, nothing will happen to the supply. Irrespective of the exchange rate changes, the supply of domestic assets is fixed, right? So now the demand of dollar, that is denoted by D, the demand curve is given based on the demand for dollar. You can see the slope, it's a negative relationship, right? If the exchange rate is higher, that means your demand is less, right? If the exchange rate is lower, that means value, right? Okay, now you can see the demand curve, right? It's moving, right, from top to bottom, or like move along with top to bottom and left to right. That is the slope. So that means it shows a negative relationship, between exchange rate and the demand for the dollar assets, right? So now you can see point A. At point A, if the equilibrium is, or like exchange rate is EA, what will happen? The value of the dollar to fall. Why? You have excess supply. you have more supply of dollar compared to demand, then the value of the dollar to fall, right? So earlier, let's assume earlier $1 is equal to 1.5 euro. Now it's going to be below that. That means the dollar value is going to fall, right? Let's assume the second point at C, where you can see the supply is less than the demand at point C. That means excess demand. So the people are demanding the dollars more than its supply. Then what will happen? The value will increase, right? That means the currency dollar appreciate. When the dollar appreciates, automatically demand will be less, right? Clear? Because the value increases, right? So price is higher now, then demand will be less. So both sides, when the excess supply of dollar, the dollar depreciates, then value decline. When the excess demand, the dollar appreciates, then value increases. So at a point B, the market will be at equilibrium. If you draw the curve at the point B, the market will be at equilibrium. So then the equilibrium exchange rate would be at E star. As I always say, when you put E star, star means at equilibrium, right? So this is very important concept, how that interest rate, exchange rate is determined in short run. It's between supply of domestic assets and the demand for domestic assets. Based on that, the equilibrium exchange rate is determined, right? When you say domestic assets, you think of dollar. Clear? Okay. Now, okay, even though like we say E stars our equilibrium exchange rate, there may be other factors that tend to change this equilibrium exchange rate. What are those factors? The important factors are: one is domestic interest rate, other one is foreign interest rate, and expected future exchange rate. Because you can see in the very first slide, the demands for domestic assets depends on two factors. One is relative expected return. Other one is value of the dollar. Right? If the relative expected return is high, demand will be high. If at a lower current value of the dollar, the quantity demanded of dollar asset is high. Right? That's what we have seen here. Right? EC, lower value, then you will get more demand, right? Okay, so these are two key factors that determine the demand. Now you can see these two factors would be changed due to domestic interest rate or foreign interest rate or expected future exchange rate. Let's look at this. First one, domestic interest rate. Now you can see the graph, right? Respond to an increase in the domestic interest rate, that is ID. When we say ID, that is the interest rate domestic. Now here, like I have to remind you again, I'm just taking two countries based on the textbook, right? Dollar and euro, right? So dollar is our domestic and euro is our foreign, right? Okay. Now the first chart, you know, right? Supply of dollar assets and demand for dollar assets. Of course, the equilibrium at E1 and the equilibrium quantities at 1. That is our equilibrium, initial equilibrium. Now, when the domestic interest rate increases, what will happen? Here you have to very carefully understand this one, right? Normally, gentle, always you think of a practical example as you can think. Now, I said like quantity of dollar assets, you can think of wherever suitable, you can think of currency itself, dollar currency, or you can think of US treasury bill that's denominated by dollar assets. Okay, now you have to think you are a US citizen and you are like the US is your domestic or your country. In that perspective, you think why I'm saying is this, you can clearly understand, right? Because the text is given that sense. Okay, now step 1, you can see a rise in the domestic interest rate shift the demand curve to the right. Now let's say US increase its interest rate, right? Now you wanted to have more currency because like now you are in euro, you have a deposit in euro, in a euro currency, but when the interest rate increases, what do you think? You will think, okay, if I can have this deposit in US, in USD, yes, of course, you will get more interest. Or you can think of when the US increases its interest rate, you can buy the US treasury that will give treasury bills that will give, or securities that will give more return. So to buy that, you need more US dollars. So either way, if you want to have a deposit in US, if you want to buy US treasury bills, you need US dollar. Then when the domestic interest rate, US interest rate increases, you will demand more US dollars. So then your demand curve will move from D1 to D2, outwards movement, right? So when the demand increases, the currency will appreciate. That means value will increase. So now new equilibrium will be at E2. That means earlier, maybe $1 is equal to 1.5 euro. Now you have to pay €2 to buy $1 because the value has gone up. So when in a short run, when the interest rate changes, it definitely going to affect the exchange rate, right? But there are, if just you have to remember always, we always say others are constant, right? Yeah, right. Okay. So I just say again, when the domestic interest rate increases, right, you will have more demand for domestic currency. So demand curve for the domestic currency will move outwards while the supply curve is fixed. Your domestic currency value will increase. So then exchange rate will increase from E1 to E2. Your new equilibrium interest rate, exchange rate is at 2. Is that okay? Okay. Second, we discussed 3 factors. One is domestic interest rate. The second is foreign interest rate. It's other way around. Just think of now, nothing changed with US. That's our domestic, right? Now, the foreign interest rate, that means euro interest rate increased. That means IF. I is interest rate, F is foreign. So response to an increase in the foreign interest rate, IF. Again, the same graph, y-axis you can see exchange rate ET, and x-axis you can see quantity of dollar assets. As we discussed, supply of dollar assets is fixed. At the initial equilibrium, right, at E1 and the equilibrium at 1, where the supply and demand curve intersect, supply S and demand 1 curve intersect. So initial equilibrium exchange rate is E1. A rise in the foreign interest rate shifts the demand curve to the left. Okay. Okay, foreign. Now, euro interest rate increases. What will happen? The investors take their dollars, deposits, take out from US and try to deposit in euro because they will get more interest. Or whoever having treasury bills in US, they would like to switch. They would like to switch euro treasury bill, right? So here what will happen? Or maybe from not only US to euro, even other countries, right? If they have deposit in Japan, they will move that deposit to euro, right? So whatever the base, when the interest rate of the foreign countries increases, that means euro is increases, right? So their demand currency for demand of currency of euro will increase, whereas, right, the USD demand will decrease, right? Why? Now US, everybody is moving from US to euro. We just looking at these 2 countries, right? Others are fixed. Okay, so for this example, I'm not talking about other countries. For this graph, what I'm saying is, okay, they are moving from USD to euro. So USD demand now will decline, right? Demand for US dollars will decline because everybody wanted to have their investment in euro, because we said earlier the demand is depending on expected return, right? Clear? Okay. So then, like, everybody is moving to euro, leaving US. So then demand for USD will decrease. That means now the demand curve will shift from D1 to D2. That means red color curve. But our assumption is clear. Others are constant, fixed. So supply, nothing is happening. It's fixed. So now the new equilibrium is at number 2, right? So now the exchange rate will fall to E2. Clear? Okay. Because of this foreign interest rate increase, the quantity of the dollar assets demand will decrease, then your value will fall, right? That means earlier $1 might be for 1.5 euro. Now you will have $1 is for 1.2 euro. Just an example I'm saying, right? Okay, so that means the value has gone down. So when the interest rate, foreign interest, so there are two different impacts, right? One is when the demand for, when the domestic interest rate increases, demand for dollar assets increases, but when the foreign interest rate increases, demand decreases. So this happening other way around, both variables. I hope you understand this one, right? Okay. Third, we are going to talk about expected future exchange rate, right? Expected future exchange rate. The response to an increase in the expected future exchange rate. Okay. Let's assume the domestic economy is US and the domestic asset is dollar assets. Okay. And the investors think expected future exchange rate, that is means capital E is exchange rate, small e means expected, T plus 1 mean today plus 1, it's a tomorrow. We always give the notation for expectation T plus 1, or if there are 5 periods, so T plus 5, right? That's okay, but T plus something, that's the future, right? T minus something is past, T is today, T plus is in the future, right? So response to an increase in the expected future exchange rate, what's happened? Let's say what's happening. Okay, now people think the future exchange rate is going to increase, right? Okay. Okay, now what will happen? So people think expected future exchange rate is going to increase. That means people wanted to by now, right? So demand will increase, right? Demand curve will move from D1 to D2, right? So the initial equilibrium at 1, there the exchange rate is E1, both are shown in blue. And now because of the rise in expected future exchange rate, expectation only, right? Expectation. So then people or investors wanted to demand more of dollar assets. What will happen? Now the dollar appreciates. That means value increases. Okay, so nothing change in supply. The equilibrium will be at 2, right? That means the exchange rate will be at E2. That means step 1, a rise in the expected future exchange rate, shift the demand curve to the right. And then step 2, leading to a rise in the current exchange rate, right? That means earlier, maybe 1.2, $1 is equal to 1.2 euro. Now $1 is equal to 1.5 euro, right? Increase in exchange rate. That means dollar value appreciated, right? Always be clear the exchange rate, which currencies you are comparing, right? And when you say value increases, what does that mean? Appreciate, depreciate, what does that mean? And exchange rate increases, what does that mean? Right? Clear? If you can have a mind mapping, that's better. Others maybe, because what I'm saying, why I'm saying is, now the y-axis is always how many euros for $1, right? That is the exchange rate we are talking about. But if it is other way around, how many dollars equal to 1 euro, then the picture is totally different way, right? So be careful, right? These labels are very important, and explanations are very important, and the curves are very important, right? You should be able to understand this. Okay, now just I can show you few examples. If the demand curve for domestic assets and affect the exchange rate, right? So we can see altogether 7 factors and how they affect the demand curve for domestic assets, and finally the changes in the exchange rate, right? So now you can see here the first column is factor, second column in change in factor, third column refers the change in quantity demanded of domestic assets at each exchange rate, right? Domestic assets. And fourth column refers to response of exchange rate, right? ET, right? What will happen to the exchange rate today, right? Okay, so you should be very careful. So we always talk about what will happen today, ET, right? See the factors. First one, what will happen to the exchange rate when the domestic interest rate increases. That means ID. We have discussed this one. When the domestic interest rate increases, then definitely the demand of the domestic assets is going to be increased. So when the demand is increased for the domestic assets, the value of the currency is going to increase. That means the exchange rate ET is going to increase. Right? That's given in the curve. Right? That means demand curve move outward. That's in the graph you can see. And second, foreign interest rate referred by IF. As we saw earlier, when the foreign interest rate increases, then people will be moving towards foreign country for investment. So demand for domestic assets will decline. That means the exchange rate will decline. Clear? Okay. Now then, expected domestic price level, right? Expected domestic price level relative to other countries, right? Okay. Now let's think. We know what is price level now, domestic price level. When I say domestic price level, it's a US price level, right? You think, okay, the expectation of this price level is what? The price level is going to increase. Now, let's see that when the price level is going to increase, what will happen? Your real return is going to be less, right? Can you remember, like we saw, like always the nominal, the Fisher effect we studied, right? Okay, so when the price level increases, then your real return is going to be less. When the real return of these domestic assets is going to be reduced, what will happen? People will be less attracted towards that because real return is less. So when the expected domestic price level is going out with regard to comparing with other countries, then you are going to have less demand for the domestic assets. So then your exchange rate is going to decline. You can see in the graph, the demand curve move from D1 to D2, moving inwards, and then exchange rates decline to E2. Okay, then let's see what will happen to expected trade barriers related to other countries. Now comparing with Europe, if the expected trade barriers increases in US, what will happen? Because of that, the trade barriers, expected trade barriers, people would like to do the trade as soon as possible, because down the line there will be trade barriers and that will cost them. So they will do the trade as soon as possible. Then they need the domestic assets or dollar to trade then what will happen? So demand for the dollar will increase. When the demand for dollar increases, then value of the dollar increase. That means appreciates. So that means exchange rate increases. You can see in the graph, the demand curve move from D1 to D2 outwards, and because of that, the exchange rate move from E1 to E2 to a new equilibrium. Right? Okay. And other factor, expected import demand. When I'm talking about the expectation, right? Continuously. If you expect like that, what will happen to the exchange rate today? That's our question now. Right? So if you expect the demand for import will increase, then what will happen? Right? So import demand is going to increase. That is our expectation. What will happen? The investors, or like the economic agent, will demand more foreign assets because to settle the import bills. So the domestic assets demand will decrease. Right? So we need, if the expected import demand is increased, then we need more foreign assets than local assets. So then local assets demand will decrease. Right? When the local assets demand, that means dollar demand decreases, definitely the exchange rate will decrease. That means value of the dollar will decrease. Right? So you can see in the graph, D1, that means demand for dollar curve, right, moving towards inwards, right? So moving inwards, right? So D2, and the new equilibrium exchange rate might be E2. And if the expected export demand increases, that means it's other way around. Earlier we discussed expected import demand increases, now expected export demand increases. So when the expected export demand increases, who is going to buy? Foreigners going to buy our stuff. Earlier, domestic people bought foreign stuff. Now foreigners is export, means foreigners is going to buy our stuff. Foreigners are going to buy our product, domestic product. So when the expected export demand increases, to buy the foreigners to buy domestic goods and services, they need to have domestic assets or domestic currency, that's dollar. So there will be more demand for dollar. There will be a more demand for dollar. So when the dollar demand is high, then definitely the value of the dollar will go up. That means the exchange rate will go up. Now you can see in the graph, when the expected export demand increases, the demand curve moves from D1 to D2, and the dollar value increases and exchange rate increases and settled at E2. That is our new equilibrium. And finally, expected productivity. What will happen to the expected productivity? When the productivity increases, of course, as I said, the average cost of the product will be less. So maybe cheaper to others to buy our domestic product. So they need more foreign currency. That means in this example, they need dollar, right? Right? So buy the cheap product, right? So demand of the domestic assets will go up. When the domestic currency demand go up, that means always keep in remember, I'm just assuming domestic economy is the US economy, domestic currency is the USD, and foreign is Europe, and their currency is Euro, right? So suddenly if you like think that, okay, Sri Lanka is domestic, then it's totally confused, right? So again, reiterate. So something explains automatically, that comes to your mind. So based on the textbooks I am explaining, so now expected productivity, that means US productivity increases. So US product might be cheaper now, then people will be trying to buy US products, so they need more currency, US currency. So the demand for US currency will increase. That means the value of currency will appreciate. So then the exchange rate will go up, right? So here I have given 7 factors, and what will happen to those demand for domestic assets due to the changes in these factors, and how that affect the exchange rate. If you are very clear, now you know, right, in a short-term scenario, how that exchange rate changes, right? So exchange rate can be changed due to domestic interest rate, due to foreign interest rate, due to expected domestic price level, expected trade barriers, expected import demand, expected export demand, expected productivity. So these are the key factors. So in a foreign exchange analysis, before you forecast anything, right, you have to think of all these factors, and you have to think which one is material, which one is not material, so you can arrive at a conclusion of what will be the exchange rate. Right? Clear? Okay, now when it comes to application, you can think of effects of changes in interest rate on the equilibrium exchange rate. Okay, changes in interest rate. When domestic real interest rate rises, domestic currency appreciates, right? This is the relationship you can see. When domestic interest rate rise due to an expected increase in inflation, the domestic currency depreciates. This is what you want to understand, right? 2 things. If the real interest rate, can you remember the nominal interest rate, the fish effect? You keep in mind, right, the relationship between nominal and real, and the influence of inflation into that, right? Okay, so real interest rate, when we when real interest rate increases, that means we are going to get more return. So then what will happen to the domestic currency, US dollar? That will appreciate. But when the domestic interest rate rises due to an expected increase in inflation, not actually real interest rate, this is due to expected increase in the inflation, then what will happen? You don't get real interest rate rises. So then what will happen? The domestic currency depreciates, because like real interest rate is going to decline, right? People assume that real interest rate is going to decline because expected increase and expected inflation is going to increase. So then what will happen to the domestic currency dollar? That would depreciate. Now, up to now, we saw nothing change in the money supply. That means dollar supply curve of the dollar, domestic assets is not changing. That is fixed, right? But a higher domestic money supply causes the domestic currency to depreciate. Just keep in mind, right? We can discuss in detail if we have further time, right? You have to keep in mind when the changes, okay, you let the money supply also change, right? Up to now, we didn't allow that to happen, right? And if you assume like, okay, money supply is going to change, that means money supply is going to be higher. That means dollar will be available more compared to past. Then what will happen? You will have excess dollar. Then automatically, right, your dollar value will come down. That means depreciate, right? So exchange rate is going to be high. Clear? Okay, in this graph, if you see, right, okay, now money supply, just I tell you, just don't get it confused, right? Okay, in this graph, if the money supply, that means the dollar increases, right? When the dollar increases, what will happen? Your currency is going to, that currency value is going to be decline, right? So now at the B maybe at B maybe the equilibrium. Now if you draw a graph here, a curve here, supply curve, let's assume that will become here. So you are going to lose your value and your exchange rate in terms of $1 to euros will decline, right? Always like keep in mind, because sometimes if, as I said earlier, right, so a depreciation mean okay, so then if you take other way around, it's kind of appreciate, right? That's what I always say. That's what I came back to this graph. Even I explain, I can like think of other graph and say, but don't get confused, right? So that's what I wanted to show this graph, right? You draw another curve, supply curve outward, because when you increase the supply, it will move outward. So you will get the graph or curve here. If you get the curve here, so now because of the increase in supply, you are going to lose value because like demand is less, right? So then your exchange rate is going to be less in terms of USD euro, right? So that's what I wanted to say there. Okay, a higher domestic money supply causes the domestic currency to depreciate. Clear? Okay. Up to now, any question? Oh, okay. The graph is here. You can see, right? This is for expected inflation, right? Look at this. Effect of a rise in the domestic interest rate as a result of an increase in expected inflation. So now expected inflation increases, because of that domestic interest rate increases. So what will happen to the exchange rate? Now, as I said, as we discussed, now there will be a change on demand curve, because now your real return out of this domestic assets is going to be less, because you expect inflation is going to be higher. When the inflation is going to be higher, your real return is going to be less. Always, for simplicity, keep that Fisher effect in mind, but you have to think a broader picture, right? I just want to keep that relationship always reminder. Okay, so then real return, when the real return comes down, people, they don't want these domestic assets. So then the demand for domestic assets will decline. That means from D1 to D2, D1 to D2. Then what will happen, right? The value of the currency will come down, the exchange rate will come down. Earlier, maybe $1 is equal to 1.5 euro. Now $1 is equal to 1.2 euro, maybe, right? Okay, clear? Okay. Now, step one, a rise in the domestic real interest as a result of the increase in expected inflation shift the demand curve to the left. Okay. Step two, leading to a fall in the exchange rate. Clear? Right. I just want to remind you, like, this is, we are comparing USD Euro, right? Europe and America. But if you are going to, if you are trying to compare Sri Lanka and US, so you should be very careful about the interest rate changes and all, because how do you interpret the exchange rate? That is very important. How you are going to quote exchange rate, right? That's very important. Okay. Okay. Up to now, okay, up to now we have seen what is exchange rate, how that is determined, what's happening in the long term, long run, and what is the relevant of one price, PPP, purchasing power parity, and then how this exchange rate is determined in the short run, what are the factors to be considered in analyzing short run fluctuation, and how exchange rate determines every factor changes, right? This is the key area. And next, what we are going to see is the market in a foreign exchange market. How, like, the players try to manipulate these exchange rates and gain out of that, right? Okay, so then we are going to see, right, who are the players and how do they deal with foreign exchange rates and do the transactions, trades, and get the benefit out of that. Okay, foreign exchange markets, unlike stock exchanges, you have place, a fixed place to do that. But foreign exchange markets have no physical marketplace. You can trade over the phone or telex or SWIFT. SWIFT means Society for Worldwide Interbank Financial Telecommunications. Through that, you can deal, right? Make your deal. Now over the phone, like, you can ask, like, even interbank markets, they call one bank to other. Okay, I have $10,000 will you be buying, or like I need $100,000, or what price you can give, right? And they take out the phone and finish the deal, right? So we call it like over-the-counter transaction, over-the-counter market, OTC market. It's a large market. Actually, this 2016 data, it's 5.1 trillion traded per day, right? USD, right? So you can check what is the current scenario, right? And the major markets are London, New York, Tokyo. These are the major markets. So trades happens, right? And this is like, you know, worldwide, like a 24 hours trading, right? Because like maybe it may be holiday in Sri Lanka, but maybe working day for other countries, right? Or it may be night in Sri Lanka, maybe working, or day maybe a day maybe other countries. So then it's a sleepless market, right? Always the trade happens. Why I'm saying? Because always the exchange rate changes. Even fraction of seconds, you will get exchange rate changes. Okay, right. This is the type of foreign exchange market. So the traders, or like people who are involved in this foreign exchange market, buying and selling these foreign exchanges, they somehow try to gain, right, out of this exchange rate fluctuation. Even though we studied, okay, this how the market or exchange rates are determined, and most of the time we could see it's an expectation. So based on the expectation, that is differs from person to person, market to market, and entity to entity. So people try to gain out of this maybe asymmetric information, right? We see, right, first type of forex markets, right? So the major types are like spot or forward, right? And the participants by market, you can see spot market we discussed, right? Simultaneous delivery, right? You deliver the currency, or like in that market, spot market, the players may be, participants may be commercial banks, brokers, or customers of commercial bank and central banks, right? In this spot market, risk is less, because like we say, the settlement happens immediately after the transaction. Just think of, now I'm going to buy dollar, so I have to give rupee, right? When I give the rupee, I get the dollar, right? So it's simultaneous, okay? So immediately after the transaction, so you book the transaction and that is settled. So it's immediate, right? So then the default risk is less. That's what settlement risk is less. Okay, yeah. But in forward market, that means it's not going to be delivered immediately. In forward market, there are like four types of players in this market. One, there may be arbitrageurs, or there may be traders, or there may be hedgers, or there may be speculators. In a forward market, four kinds of transaction would take place, right? Okay, first let's see arbitrageurs, right? What they do. Arbitrageurs do trading that trading is called forex arbitrage, right? It's a strategy, a risk-free strategy. So then they don't need to take any risk in their books just to trade simultaneously, right? They just buy and sell quickly, right? This allows retail forex trader to make a profit with no open currency exposure, right? Now you have to understand one key point here that allows this arbitrage allows retail forex trader to make profit. Okay. Currency exposure. What do you mean by open currency exposure? Right? If you buy foreign currency, if you buy dollars and keep it with you today, and tomorrow, let's assume the foreign exchange rate changes, you may be losing. Or if you sell your dollars without buying, already you have, okay, you sell, right? You may be now a minus or deficit in dollars. So if something happened to the rate, when you settle, you have to buy and settle. So then you are exposed to exchange rate risk. Both, right? So if you buy, you are keeping. So if you have assets, foreign currency assets, so if you buy and keep with you, that's assets. So we call it long position. You are having dollar. When the exchange rate fluctuates, then you may lose. That is we call open currency exposure. Currency exposure. You have open position. You are long. Or sometimes other way around, you may be short. If you oversold, you are deficit in dollar now. A minus balance. We call it short position. So if you want to settle that short position at later stage, you have to buy. Then again, you have to go to market. Then the rate may be different. So then that also you are having open currency exposure. Now you understand what is open currency exposure. If you are long, still open currency. If you are short, still open currency. But if you buy and sell and your position is zero, means that means you don't have assets as well as you don't have liability. That means your position is zero. That means there's no open currency exposure. There's no open position. So these forex traders, that means arbitrators, they don't keep open currency exposure. They just buy and sell quickly or sell and buy quickly, right? Immediately, right? So the strategy involves acting fast on the opportunities presented by pricing inefficiencies while they exist. What will happen? There are so many exchange rates. You can buy one and sell different one buy one currency and sell different currency, then again buy, again sell, again buy, again sell. So many different currencies, and you can see the little price differences. That is called pricing inefficiencies. Maybe Sri Lanka market, right, working in different way. Now say an example rather than going in deep sense, like bank A is selling at $200 rupees, right? Bank B buying dollar for 202 rupees. What you can do, you can just buy from bank A at 200 and sell it to bank B 202. You make 2 rupee profit immediately, buying and selling. I have no position now. I just bought dollars and sold to bank B. Finish. Because this is the pricing inefficiencies, right? This is an example. But worldwide, because of the country's infrastructure, understanding, expectation, everything, you can find these mismatches. Now it's system oriented, right? So then you can like see the mismatches and quickly act upon, because like within a second it will go off, right? Because like everybody around the world, sleepless market, everybody is doing deals, so it will be like fraction of second will be not available, so you have to act very fast, right? And grab the opportunity, right? So you use these arbitrages, use these pricing inefficiencies, and doing buying and selling in different currency pairs, right? Different currency pairs. You buy USD euro, then you sell USD yen, and then you go for USD sterling. Like you have to think of like that, hmm? And exploit any inefficiency of repricing and gain gain accordingly. I have given an example, right? You can see this. The current exchange rate of the Euro USD, Euro GBP, GBP USD pairs are 1.1837, 0.7231, and 1.6388 respectively. So that means Euro USD rate is 1.6388. Oh, sorry, 1.1837, and GBP Euro 0.7231, and USD GBP 1.6388. Right? Okay. See this example. And now, in this case, a forex trader could buy one mini lot. When we say one mini lot is 10,000, right? 10,000 euro, right? So if you want to buy 10,000 euro, right, you have to pay 11,837 USD. Right here, like you have to see these codes. It says like 1 euro is how much USD, 1 euro is how much GBP, 1 GBP is how much USD. That's a rate given, right? I said like rates are quoted in different ways. You should be very careful and see and reconfirm through the practical scenario, right? You can think of which one is like more valuable, right, based on the rate, exchange rate, and see, right? Okay, if you want to buy 10,000 euro, you have to pay 11,837 USD, right? Now you bought euro, 10,000 euros. Now you are going to sell that euros to British pound. If you are going to sell that euro to British pounds, how many British pound you will get? Because 1 euro is equal to 0.7231. So then you will get 7,231 British pounds. Now, you gave USD 11,837 USD and bought 10,000 euro. Now you sold again 10,000 euro, bought 7,231 British pounds. Now you are going to sell these 7,200 British pounds and buy USD, kind of circle. when you buy USD, what is the rate? 1 GBP is equal to 1.6388. That means you will get, if you sell GBP 1 GBP, you will get 1.6388 USD. That means when you sell 7,231 GBP, you will get 11,850 USD. Now you see, earlier you had 11,837 USD. Now you have 11,850 USD. You made a profit of $13 due to this transaction without taking any risk. You have done quickly because of the price inefficiencies, price differences between these pairs of currencies. You have no open position. Earlier you had USD, still you have USD, nothing changed. But now you have $13 more. Right? Earlier I said only 10,000. That is the mini lot, we call it. But if you go for a normal lots, that's a 100,000. If you do it for $100,000, then you will get additionally $130. The arbitrageurs can do this continuously until this pricing race traded away. Pricing inefficiency vanished. Is that okay? Right. So this is one of the in the foreign exchange market everywhere around the world, they look for a gain and do it continuously. Right. So in a forex market, they try to exploit the pricing inefficiencies and try to gain some benefits. Next, the players we call traders. They trade foreign currency, right? They buy dollars and for like euro maybe. So they also one of the key people, right? Forex trading is trading currencies from different countries against each other, just trading, right? For different currencies. For example, forex trade is to buy the euro while simultaneously selling US dollar. So you buy and sell, right? So when you buy, like if you take like Sri Lankan situation, if I want to buy dollar, that's one leg, other leg I'm going to sell rupee, right? So you give the rupee and buy dollar. So it's that when you say trading, the important word is simultaneously you do that. When you do that, you create exposure. We discussed earlier foreign currency exposure, open currency exposure. When you buy USD, what do you call that? Long. You are long on USD. Right? Okay. Now you have, like when you have USD more, then that is risky because like when the USD exchange rate fluctuates, you also will have, right, loss or gain. Right? This kind of forex trading is typically done through a broker or market maker. Market maker, when usually in theoretically we call whoever like quoting both ways, buy and selling, buying rate and selling rate. If somebody can quote that, they are the market maker, right? So then the traders are market makers, right? Okay. Another part is hedgers, right? Third category is hedgers. They do hedging, right? The foreign currency transactions happens for hedging purpose. What do you mean by hedging? If somebody wants to protect themselves from losses arising from exchange rate movements, they can do hedging transaction. Right? Okay, so then some brokers do the hedging directly. That means, now example, you have a position, open position, or $10,000 open position. To mitigate that risk, you will do another trading and you square your position, right? That means zero. You have no more position. Then you are safe, right? Hedging from big losses or big, like a huge transaction. Normally they do back to back, right? Transaction to hedge. So you can think of direct hedging. That is when you are allowed to place a trade that buys a currency pair, and then at the same time you can place a trade to sell the same pair, right? If you can place two orders, right, to sell as well as buy as well, that is direct hedging. Normally banks, they don't want to keep the open position too much because they want to reduce the risk, so they do hedging, back-to-back transactions. The fourth category, yeah, speculators. This means the person or institution that bought or sold the currency has no plan to actually take delivery of the currency in the end. Rather, they were solely speculating on the movement of that particular currency, right? Okay, now actually, like, there's the category people speculate. They speculate the rates, okay? So they book the transaction expecting the changes in the exchange rate, and they don't go for, like, they will have the time to deliver, so they don't do the delivery. Within that, they again do the counter transactions, then make the square, right? What they do is they try to get profit out of the movement of that particular currency, right? So speculators are like huge quantity is done by speculators. So they are the people, like, they don't do actual deliver, right? Clear? So now there are four sets of people we have seen: arbitrageurs, traders, and hedgers, and speculators, right? So now these people, as I said, are key agent in the foreign exchange market, try to exploit or like try to do the deal and gain benefits out of it. So today we have seen, right? I just want to conclude the session today, so we can start the balance from other the next class. So today we have seen what is exchange rate, how that is determined, and what is law of one price, the importance of purchasing power parity, so the relationship, and then how exchange rate is determined in long run, and then how that's happened in short run, and then the major players in the foreign exchange market and their activities. Okay, so then balance we can see in the next class. Is there any question?